What's up, guys? Hey, it's Clint Coons here, and in this video, I'm going to talk about how do you sell your personal residence and not pay any tax on the sale. Okay, let's get started. All right, so here's the thing. When it comes to selling a personal residence, many people aren't aware of the various strategies that exist out there that allow you to sell your personal property and not have to pay any tax on it. Everyone is most familiar with this strategy right here, which is referred to as Section 121. And what does that mean? Well, if I have a personal residence that I've owned for 2 out of the past 5 years, okay, we have this couple that's owned it 2 out of 5 years, 2 of 5, they can sell this property and they can exclude from taxation $250,000 per person. All right, so in this example here, this couple can exclude $500K in gain from taxes. So if they bought the house here for $300,000, okay, that's what their acquisition price is. They remodeled it at one point in time, maybe put in a pool, so they spent another $200,000 over the past 10 years while they've lived there. That brings their tax basis now up to $500,000. So it's initially what they paid for it plus whatever improvements they've made to the property. So that's what their tax basis is. If they sell this property for anything less than $1 million, then their gain is going to be $500,000 or less. So their gain is completely tax-free to them. So they can sell it, they can bring that money in, they don't have to pay any tax on it, because they have sufficient basis here to keep the gain under the $500K. Now, if you go over the $500K, let's say that the property is going to sell for $1.1 million. So now you're going to have $100,000 in taxable gain here. So this $100,000 in excess income or amount that we receive, that $100K, it's going to be taxed at 20%. So you'll pay taxes of $20,000 on the sale of this house in my example where it's $1.1 million. So the question that comes up many times when I'm talking to someone who has a personal residence is that we first discuss 121. But let's say, Clint, yeah, I know about that strategy. I can sell my house, but you don't understand, I live in California and we've blown right past this number right here. Why don't you do this? Why don't you add not $500,000, I'm going to have $1.5 million in gain when I sell this property. And that's going to take this number here and we're going to add a zero on there. So now I have $200,000 in taxes, and I just don't like those numbers. So what can we do with this scenario to help minimize it from a tax standpoint for that particular client? Well, actually, there's some options here. Okay, if you don't want to pay tax, one of the things that you could do in this scenario is convert your house. All right, what do I mean by convert your house? Turn it into an investment property for a short period of time. So if you turn this property into an investment property, I mean you make it a rental, okay, and you hold it for investment, now you can qualify for Section 1031, which is a tax-deferred exchange. So if I move out of the property and I turn it into a rental, maybe you make it a short-term Airbnb, you do something like that for a while there with this property. Then when I go to sell, I could exclude all $1.5 million in gain on the sale of that property. Now the problem with this strategy, yes, you get to avoid paying tax on that entire gain because now under, it's a Section 1031, you're selling an investment property. What you're required to do is roll all of that amount that you bring in, which $1.5 million in gain plus your basis of $500,000. So you have a total of $2 million you have to roll into replacement real estate. So that means you have to use that to buy other investment properties, which isn't a bad thing, right? Because you may be thinking, well, Clint, what about where am I going to live? I'm going to get to that. So you take this asset, you roll into some replacement properties. Say I have 2 properties here that I roll it into like this, each of them valued at $1 million. Okay, so now I've moved in $2 million tax-free into these 2 properties. Then I'm going to turn around later and I'm going to borrow back out some money. So I borrow back out $1 million, 500 against each, come over here and buy my new personal residence. So that's a strategy you can use when you're engaging with a property that has more basis or more gain than the 121 exclusion. Turn it into an investment property, sell it under a 1031 exchange, and then go back in and tap in the equity a little later date. Now you can't make this boom, 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 right? Turn it into a rental for a week, then turn around and say it's 1031 property, sell it under 1031, roll it into a property. After you close, turn around and do a cash out refi immediately. That's not going to happen because it'll show that it's tax motivated, that you didn't truly have an intent to utilize 1031 in this structure. So there has to be some time here. We can talk about that with your tax advisor on how the way you should set this up. So that's one option. A second option to utilize this scenario is treat it as a mixed use property. That means that you want to treat a portion of it as your personal residence and another portion of it will be treated as investment property. So in that scenario, you use the 121 for $500,000 in gain, and you use the 1 million for a 1031 exchange. So that would be a mixed use scenario way of exploring how to get out of a personal residence and minimize the overall tax hit that we're gonna take. All right, and then the third option you have to look at when selling a piece of property, and this really comes down to what do you want to do with the asset? Do you need all that cash? And so the scenario I'm referring to is I had a client that came to me and they had a piece of property right here. Their all-in basis was $1 million. And they had actually, now the property was worth I think it was $1.7 million. Now they intended to take this property and turn it into a short-term rental. So they weren't necessarily going to sell, they're going to sell it, but they wanted to convert its use. And so they wanted to make sure, how do I convert the use on this property, but still treat it as a sale so I can pick up this $500,000 gain? Because once I roll it into an investment scenario, like I just showed you earlier, then you're stuck with the 1031 exchange. So to pull the cash out, it gets a little more complicated, as I was showing. You have to borrow the money back out. So one of the options, if you're sitting in a situation where you have gain on sale of a property, that's no more than $700,000 total, because then it can get a little wonky. I mean, we can still run the numbers. But if you're in that scenario, what you might want to consider, and you're going to use this property as an investment property, set up a corporation. So I would come over here, and what I did is I set up a limited liability company, an LLC, and we treated it as an S-Corp. Now I know if you've watched my videos, I said never own rental real estate in an S-Corporation. And again, it's not a one-size-fits-all. There's always going to be an exception to every general rule. You just have to figure out what's in the best interest, what are we trying to accomplish, and then put together a solution. The problem here was, for this individual client, hey, I want to turn this into a short-term rental, and of course, I want to have, not only have my cake, I want to eat it too. So how do I avoid $500,000 in tax on that property when I sell it in the future? How do I harvest that? So what we did is we sold the property to the S Corporation, of course, the LLC that the clients own. So they sold it to the S Corporation for $1.7 million, and we sold it on an installment note. All right, so if you watch my video on how to finance rental real estate, residential real estate, one of the options there was seller financing. Well, that's what we're doing here, where they're actually seller financing the property to their own company, right? You can do this. Now, they had to come up with a down payment, so you had to have some cash here. So they had $200K in cash that they put into the entity that they paid out to themselves per this transaction. So when you look at it, it's got all the touch and feel of a traditional transaction at an arm's length distance. So we sold the property at $1.7 million under an installment sale. Now, remember, they bought the property for $1 million. We sold it for $1.7. So how much gain is there? $700K. So when you sell property on an installment sale, the typical way this is treated for tax purposes is you only pay tax on the money you receive. So in this case, if I only receive $200,000, then I'm going to get taxed on about 45% of that amount, because a lot of that is a return to my basis. $1 million there is return of basis. So you do this calculation to determine what is your total gain, and that's how much you would pay tax on. So when you receive money, you're not paying tax on the whole amount because you have a tax basis there you get to offset against the money you received. So we paid $200K out, and then they're going to pay under this installment sale agreement. Let's say they're paying $10,000 a month. So they're going to pay this over time. But here's where the issue comes in. If we just stuck with this scenario, then the entire $700,000 in gain will be taxable to them because they're paying tax on this money as it comes in over 20 years. Now, what I wanted to do for them was put them in a scenario where rather than have to pay tax on the full $700,000 gain, we're only going to pay tax on $200,000 over 20 years. I'm going to put $500,000 tax-free into their pocket. How did we do that? The way in which we did this is we sold this, as I stated, under an installment sale, and then on their 1040, we said, yes, we sold this property, our personal residence, under an installment sale, but we choose to elect out of installment sale treatment, and we want to be taxed all in year one on the full $1.7 million. Now you're probably wondering, why would you do that? Well, let's look at the numbers here. I've got $1.7 million that comes in. My tax basis is $1 million, all right? So my gain is $700K. Now, what type of property did I sell? I sold a personal residence, right? So what tax provision did we talk about at the very beginning where you can sell a personal residence and not pay tax on $500,000? Well, that is Section 121. So I can claim my 121 exemption against this $700,000. Even though I haven't received it yet, I'm electing out of treating it the installment sale. So I can claim my exemption of $500K out of here. So that's non-taxable. That leaves my true gain of $200,000. Now, what is the tax rate on anything above $500K? I told you it's 20%. What's 20% of $200,000? That's $40K. So in order to sell this property in this scenario, my clients had to pay $40,000 in federal income tax. But as a result of this, they were able to avoid paying taxes on $500,000 in gain. Now, they don't have the money up front because that S corporation is going to pay them over time. But as they take that money in, since they paid tax and recognize it all in this year's return, they won't be paying taxes on that money as it comes into them over the next 20 years. Well, they will on the interest portion, but you would on interest no matter what. So this strategy right here is one of those for individuals who want to take their personal residence and turn it into, say, a short-term rental or another rental property. And you want to avoid or minimize your tax hit on that. Sell it to an LLC, tax as an S Corp. And the other benefit is that you get to increase your tax basis because a lot of people will just turn their personal residence into a rental and miss this strategy as well. That by sending it over here at 1.7, my tax basis in this property now is 1.7 for depreciation purposes. So then I could go in here and possibly do a cost seg or just straight line depreciation and use that to offset the income I'm bringing in from my short-term rental business. Versus if I didn't do that, my cost basis would only be $1 million. So I gave myself $700,000 in additional tax write-offs by using this strategy. Guys, the numbers are great. You just have to know where to go to receive this type of strategy planning. You know what to do. Go to the strategy session link that I have in the show notes. Get with one of my advisors. We can talk about what we can do for you in your situation to make sure you're optimizing your taxes and your asset protection when it comes to real estate investing. Take care.